Welcome to the deep dive. Today, we're pulling back the curtain on something really important if you're involved in the Nepali stock market.
Hmm.
Nepse broker commissions. It's one of those things, easily overlooked.
Definitely.
Our mission today, we want to really break down what these costs are, how they actually impact your bottom line,
Yeah.
and give you some solid tips to, well, keep more of your money working for you. Okay, let's unpack this.
What's truly fascinating here, I think, is how tiny these fees seem on the surface.
Right.
But they can seriously eat into your actual gains over time. We're talking maybe 10, 20, sometimes even more % of your profit.
Wow.
Especially if you trade frequently. They're not just transaction costs. They can be like hidden profit killers if you're not watching.
Okay, so let's get specific. What exactly are we paying for with these NEPSE broker commissions?
Hmm.
Basically, when you buy or sell shares, your broker charges a service fee, right?
Right.
And this isn't just made up. It's regulated by NEPSE, the stock exchange, and SEBIN, the securities board. It provides structure.
Exactly. Keeps things orderly.
In this fee, it has a few parts. First up is the main broker commission.
Yeah.
That usually sits somewhere between 0.4% and 0.6% of how much you're trading.
Yeah.
And different brokers might charge slightly different rates within that range.
That's right. There's some variance there.
Then you've got the SEBIN fee. Much smaller, this one.
Tiny. Yeah.
It's 0.015%, and NPSE actually collects that.
For regulatory oversight.
And finally, there's the DP fee. This one's a flat charge, or it's 25 per transaction.
Okay.
That's for handling the shares, getting them into your DIMET account, your digital account.
Right, the electronic side of things. And these fees, they're not just arbitrary, they're essential.
How so?
Well, the broker commission pays the broker for, making the trade happen, providing the platform.
Okay, makes sense.
The SEBIN fee funds the regulator, SEBIN, which ensures the market is fair and transparent, protects investors like you.
Right, important stuff.
And the DP fee covers the cost of maintaining that electronic record of your shares. So together, they help the whole system run smoothly and securely.
Okay, got it. So we know the components. But let's talk real money. How do these percentages actually hit your wallet on a typical trade?
Yeah, let's crunch some numbers.
Say you invest Rs 10,000 in some shares. Let's walk through that cost.
Okay. So Rs 10,000. Let's use, say, a 0.5% broker commission right in the middle.
Okay.
That's Rs 50 for the broker commission. Simple enough.
50 rupees, okay.
Then the SEBIN fee, 0.015% of 10,000. That's just Rs 1.50.
Okay, very small.
Very small. But then here's where it gets really interesting. That flat DP fee, Rs 25. Every single time.
Every time you buy or sell.
Exactly. So add it up. Rs 50 plus Rs, 1.50 plus Rs 25, that's Rs, 76.50 total cost just to buy those shares.
76.50. And like you said, that Rs 25 DP fee, it's the same whether you trade Rs 10,000 or Rs 1,000.
Yeah, precisely. Which means it hits smaller trades much harder, proportionally. That Rs 25 is 2.5% on an Rs 1,000 trade just for that one fee component.
Ouch. That really changes the maths for smaller investors.
It absolutely does. It makes frequent small trades less efficient.
And crucially, like you hinted, that R76.50, that's just the cost to get in.
Yep. You pay again when you sell. Maybe not the exact same amount if the sale price is different, but the percentages and the DP fee apply again.
So it's a round-trip cost. Okay, this makes it clear why understanding this is so vital. It really adds up.
It compounds.
So the big question then, what can you, the listener, actually do about this? How can you minimize these costs and keep more of your returns?
Right. Let's get practical. There are definitely strategies. First off, choosing the right broker. It matters.
How so?
Well, like we said, the commission ranges from 0.4% to 0.6%. Some brokers consistently offer rates closer to that 0.4% lower end.
So shop around.
Absolutely. Compare their rates. It might seem small, but it adds up. Second strategy. Consider larger transactions.
Okay, why larger?
Often, brokers have tiered commissions. The percentage might actually drop slightly if your transaction value is higher. So trading Rs 50,000 at once might have a slightly lower effective rate than 5 trades of Rs 10,000.
Ah, interesting. Economies of scale, kind of.
Sort of, yeah. But you need the capital for that, obviously.
But hang on, that difference between, say, 0.4% and 0.5%, that 0.1%, for an average person, maybe not trading huge amounts, does it really make a big difference? Isn't that kind of marginal?
It feels marginal, I get that. But think about it cumulatively. Let's say you trade, Rs 50,000 worth, buying and selling each month. That's Rs 600,000 in transactions a year.
Okay.
That 0.1% difference is Rs 600 saved. Or maybe you trade more, maybe RS 100,000 a month. That's RS 1,200 a year saved just by picking a slightly cheaper broker.
Okay. When you put it like that, over a year.
Mm-hmm.
Yeah, it's not nothing. It's money you could have reinvested.
Exactly. It's about the long game. Which leads to the third strategy,
Really?
long-term investment.
Right. Less trading means fewer fees.
Precisely. If you're constantly jumping in and out, buying and selling frequently, you're racking up those commission charges and DP fees every single time.
Erodes the profits.
Massively. Holding shares for the longer term, focusing on company fundamentals rather than short-term fluctuations, that's often much more cost-effective from a commission standpoint.
Makes sense. But, there's always that temptation, right? The idea that active trading, catching quick market swings, could make you more profit, even with the fees. What about that siren song?
Oh, it's definitely a siren song. And look, some highly sophisticated traders might make it work.
Might.
But for the average retail investor, the reality is the constant drag of commissions, plus taxes, which we haven't even detailed yet, often wipes out those potential short-term gains.
So it's riskier and often less profitable in practice.
Generally, yes. Patience tends to be rewarded more reliably in the market than constant churning, especially once you factor in all the costs.
Okay, let's tackle a couple of common questions we hear about this. First one, people use online platforms like MeroShare or Culti now. Is the commission lower if you use those?
Good question. And the answer is generally no, not intrinsically. Those platforms, MeroShare, Culti, they offer fantastic convenience, making trading easier, more accessible.
Definitely.
But the commission rate itself is still set by your chosen broker. The platform is just the interface. So the broker's underlying rate between 0.4% and 0.6% still applies. You don't get a discount just for using the app or website.
Got it. Convenience, yes. Lower base commission, no.
Oh.
Okay. Second question, and this raises an important point. We've talked a lot about broker commissions. Are there other fees or costs involved besides these?
Ah, yes. This is crucial. The broker commission, 7-fee, DP fee, that's one part of the picture. But you absolutely need to consider taxes.
This is right.
It's like, seeing the price on a menu and forgetting about VAT or service charge.
Good analogy.
In the stock market, the main one is capital gains tax. This applies when you sell shares for a profit.
Only on profits.
Only on profits. The rate usually ranges from 5% to 10%, depending on how long you held the shares.
Yeah.
If you sell at a loss, no capital gains tax.
Okay, it's clear. 5 to 10% on the profit. What else?
Then there's dividend tax. If the companies you own shares in pay out dividends, a portion of profit,
Yeah.
there's typically a 5% tax on that dividend income. Usually it's deducted at source, meaning the company handles it before the money even hits your account.
So it's kind of automatic.
Often, yes. But both capital gains tax and a dividend tax are separate from broker commissions, and they definitely impact your total return. You have to factor them in.
Absolutely. So, okay, what does this all boil down to for you, the listener? We've really dug into these NEPSE broker commissions today.
We have.
We've broken down how they work, the real cost, and crucially, how they pile up. Understanding this, it really shows how small commission, big savings can be a reality over time. Knowing these costs, planning around them, it's just fundamental to making smart investment decisions, isn't it? It really is. It moves you from just buying a stock to actually managing an investment.
So maybe a final thought for people to chew on?
Yeah, I think the key takeaway, the thing to really internalize, is this. Never just look at the share price alone.
Right.
Always, always factor in all the associated costs. The commission, the Subin fee, the DP fee, and the potential taxes, capital gains, dividend tax.
A whole picture.
The whole picture. Because only when you understand that total cost structure can you accurately evaluate the real potential return on your investment and figure out your actual net profitability. That comprehensive view, that's essential.